Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on the race to financial freedom through real estate investing and sound financial practices. My name is Mike Moe, one of the hosts of the show. Joined with me today, tonight, this evening, this morning, whenever you're listening to this, with Mr. Fierro. How you doing, man?
Mike, I'm doing fantastic this evening, this morning, tonight, whenever they're listening to us.
You forgot this. Yeah, you forgot 2 a.m. in the morning. Who's listening to this at 2 a.m.?
Yeah, for all you guys, go to sleep.
Yeah, right.
Happy birthday to you guys that are having birthday today, too, by the way.
There you go. Merry Christmas.
Yes.
Happy Easter.
Have we covered all of our bases?
I don't know. Probably not by now.
That's all right. Well, if we missed you guys and you're not listening to it right now, then, have a good day anyway.
Yes, man. How you doing, dude?
I'm doing well, man. Got back from a camping trip on Sunday, and I was home for a couple days, trying to get caught up on office stuff, and I'm going back out camping tomorrow for the 4th of July weekend.
Might as well just live in the woods, man.
Dude, it's one of those things where I've been stuck in that 8 to 5, 9 to 5 job for so long that a little bit of freedom, and I'm kind of going like college crazy. When you first went to college, you just kind of lost a little bit. Maybe you had a couple of beers too many at a party or something.
There you go, man. So, you got to live it up. You got to live it up, man. Take advantage of it.
I am. I'm having a good time with it, but I'm kind of excited about that. And how is everything going out there, man? Minnesota.
Just fantastic, dude. It's Minnesota summers. It's about the only thing that's good about Minnesota weather is the summer. So we're enjoying it as much as we can in this COVID craziness. But yeah, it's good, man.
Yeah, good. So exciting today. We're picking up where we left off last week with the syndication, right?
Yeah, dude. So continuing on this investor basic series that we're on, this little journey with, to your point, syndication. So we went over syndications last week and the high level kind of some how syndications, what is a syndication, right? And talked a little bit about what it is, structures of it, the different pieces that make up a syndication. And now we're going to take it from the limited partners side, man. What does it look like for, if you're interested in investing in a syndication as a passive investor? What are some key things to look for? And it's gonna be a good one.
Yeah, I'm excited because limited partner, when you think passive investing, this is, for the most part, this is what I think of whenever people are saying we're earning a good return passively. Limited partner is the way I'm thinking of it, because it's, as we discussed last week, the general partner, the GP, has a lot more involvement in the actual deal, whereas a limited partner, they're limited in what they are able to do for the deal.
Yeah, exactly. It's at least definitely the most common way. People say I'm investing passively in real estate. Typically, it's through a syndication. Could also be through it may be through like a REIT or something like that as well, which is almost like a stock essentially. It basically is a stock of a real estate holding. So, but yeah, passive investing through syndications is definitely a popular one, and definitely a good way for people to get exposure to real estate without doing a ton of the legwork that's involved with it.
Yeah, there is a lot of legwork involved in a lot of these projects, and when you want to just sit back and collect your revenue, collect your interest, collect whatever you're collecting, and not have to do a ton of stuff for it. I mean, like you said, you do have to do your due diligence on the people that you're investing with and that sort of thing. Or we're going to get into that in a minute, but you get the least amount of input, the least amount of work involved in this kind of investing.
Yeah, and that's a super clear distinction to make, man, because it's not like the ownership is not on you to vet some of these deals and vet some of these the sponsors, because you certainly want to understand the deal in its entirety to know how you're going to get paid, how it's going to perform, and make sure you're not just having somebody blow smoke for some of these returns. So you might end up still losing a ton of money if you do passively that way. So we're gonna cover a few things that might help you avoid that scenario.
Yeah. So what do you think? You want me to jump right into the warm up? Because I'm excited about this one.
Yeah, dude, let's do it.
All right. For the warm up today, we're doing capitalization rate, also known as cap rate. The cap rate is the rate of return based on the income that the property is expected to generate, also referred to as the cap rate. The cap rate is calculated by dividing the net operating income by the current market value of a property.
Yeah, man,
Wow.
It's definitely a common term in real estate, and it's a nice apples to apples comparison between properties because it doesn't factor in the debt that you have on it. It's essentially looking at the return divided by the price of the property price, regardless of the debt. So you're not going to get different. You're not going to get a different return if somebody gets different financing or something like that from a cap rate perspective. And there's a ton to go into a cap rate because obviously it's impacted by the NOI, right? Your net operating income that you mentioned, and then by the sale price or the market value of the property. So if somebody picks up this property, if you buy the property and your NOI goes down, obviously your cap rate is going to be impacted. And there's a ton of different things that go into that. So there's also a bunch of different cap rate types of cap rate. So the cap rate on the property, the market cap rate, which is, to your point, I think you mentioned before we started recording, it's almost like the comparable sales within your market for a single family home there's a market cap rate that will be used to evaluate the value of your property divided by the NOI. So you want to know what's commonplace in your market so you can know how to evaluate these properties.
Yeah, and it's just another thing that you have to pay attention to when you're doing these to make sure that you get this item cap rate correctly, because if you make a mistake on this, that could mean the difference between a profitable project and, one that's going to bankrupt you, and that's never a good scenario.
Yeah, and it'll tell you, if you know your market cap rate, if you know what's commonplace in your market, it'll tell you whether or not you're in the ballpark for a reasonable deal, right? So if you're in a market that is typically properties sell at a 6 cap or a 6.5 cap, and you're buying the property at a 3 cap or a 4 cap, well, obviously you know that you got some concerns there because you're overpaying for that, potentially overpaying for that. It's a red flag that you want to dive in a little bit deeper for. So.
Yeah, and I also did have somebody tell me once the higher the cap rate, the more risk you're taking. You're assuming more of a risk, and the lower the cap rate, the more stabilized the property is. That's one of the things that they had said. I have not been able to confirm or deny it, but that's what
I guess risk is everybody's got a different opinion on risk, right? So, but you're right. Typically your A-class properties or things like that will have lower cap rates because they're perceived as less risky. And then a lot of things that the people that we rub shoulders with invest in, like those C plus B class properties that are value add. Those will typically have a little bit higher cap rate because they're perceived as a little bit more risky sometimes. If there's a big value add play, if there's a big reposition that needs to happen, or just because they're an older asset, right? You're not going to pay the same. You're not going to pay the same price for a 2000 build, as you would for a 60s build. So the asset has a lot to go into that as well. But yeah, some people will perceive higher cap rates with more risk, but that's opinions.
Yeah. So let's jump into the overview here. You wanna start here? Why invest passively, Mike? What is the benefits?
Well, man, we talk a lot about goals. We talk a lot about starting with the end in mind, and I think passive investing as a limited partner has a place in a lot of people's goals and a lot of people's investment strategy. And really, like we talked about it, you get real estate exposure without all the risk and the legwork. So as we talked, I think we covered this in the previous episode, but LP, limited partner, also means that you are limited liability, right? So the only thing that you can essentially that you're losing is your investment. So if you invest $100,000 into a syndication, sure, you can absolutely 100% lose that $100,000, but you're not going to get sued if the deal, if somebody trips or on the property, or if the tenants want to sue you. They're not going after you. They're going after the general partners or the entity that owns the property through the general partnership. So it is a limited liability from that standpoint, and you're not putting all your other assets at risk. The other side of it, man, is just passive. Like this is a really good tool for those high income earners. Like if you are somebody who is dead set on their career, loves what they do. Maybe you're a doctor, lawyer, physician, in the tech field, but you don't have any plans of leaving. You don't have any plans of wanting to get heavily involved in real estate. The limited partner side can really give you a ton of benefits from a tax perspective to lower your tax burden. And especially, you guys know, in the high income tax brackets, you want to look for every avenue as possible to lower that tax burden.
Yeah, you don't want to. You get all the tax benefits and none of the hard work that you associate with real estate investing. No change in toilets at 2 a.m. and that sort of thing. You have people that do that for you, and you can sit back and just use your money to make money and bring it in. And a lot of millionaires invest this way as part of their additional income streams. I mean, they do different kinds of deals, and this can be another income stream for you without very much worry or concern.
Oh yeah, for sure. This is definitely one, to your point, is leveraged by those people who, they're just looking for a good return, exposure to real estate, and maybe they've done the general partnership, so many times, and now they're at a point where they don't need to hustle for that GP side of it, and they're just looking to do it passively. So great opportunity for anybody who wants to get exposure to real estate but doesn't want to asset manage a deal, find the deal, put it together, and kind of grind on that side of it.
The tax benefits also in passively investing are just so phenomenal. When you get your, what is it, a K1?
K1, yep.
K1 goes against your personal income as well. And I've heard stories of people investing $100,000 in a limited partnership and getting over $100,000 in tax deductions off of that partnership, and it's all completely legitimate.
Oh yeah, for sure, man. Especially if you got some crafty sponsors who are doing things like cost segregations and things that will increase you realizing those tax benefits in those first handful of years. You can have a sizable investment like that, make a good return, and then still show a paper loss, because of these the tax benefits of real estate. So,
and it's not about how much you make; it's about how much you keep.
Exactly, man. Yeah, absolutely.
And now this type of investing, is this actual passive? Like we had said, it's one of those things where you actually don't have to go and do the toilets. You don't have to find the deals. You don't have to do any of that. The only thing you have to do is what we're going to talk about next, is that warning right there. How exactly do we find the right people to invest with?
Yeah, man, this is the fair warning, the PSA for this episode. And I think we covered it last time, but just because you're investing passively, you do not relinquish your right or your need to research the deal, to understand the sponsor, to understand the market. You still have to understand how this deal is going to work and how you are getting paid, how the sponsor is getting paid. You want to, all that stuff is clearly written out in the operating agreement, but you want to understand that going forward, so you understand how they're getting paid and make sure it aligns with your interests. This is not like just hand your money over and walk away, because you need to vet these things and vet these people before you write that check. So
one of the things I also think you need to do is, when you're doing your research and knowledge, you really want to invest in a market and a submarket that you have some connection to or that you believe in wholeheartedly. So that gives you a little bit more skin in the game. If it's a market that you understand, it's a market that you know, then at least that way you'll be able to tell whether or not the deal is going to be in a good area or a bad area, or what the situation is with it.
Yeah, 100%. Yeah, knowing the market is good, doing your research, just like we talked about, if you're investing in the deal yourself or buying a property yourself, you want to at least understand the market at a high level and the sub-market at a high level to understand what's the crime rate, what's average rent. So if you got a sponsor who's saying, we're going to buy this deal and we're going to move it from $600 a month rents to $1,000, and you know for a fact that nobody in that area can afford $1,000 rent, or that no property is charged $1,000 and the closest one is $750, $800, you can call BS on that and save your money and go elsewhere. So it's important to understand, to your point, Larry, that at least the parts of the market that are key, like the income, the average rents, the crime rate, and then just believe in the market as a whole, right? Like, if you don't believe that this market as a whole is going to be stronger in 5 years than it is now, then you probably shouldn't be investing in that market. So you don't just want to throw a dart at the map and pick a sponsor where it lands. You want to truly be invested in a market that you believe in.
And you also have to understand the asset class of the properties that you're looking for. Do you want to go with an A class? Do you want to go with a B class? Do you want to invest in C classes? And then what is the ramifications of each of those classes? What kind of tenants are you looking for? What kind of markets are you going to be buying those in? And what are the different challenges? I mean, not all classes are run the exact same way. You're going to run a class A property vastly different than you would run a class C property.
Yeah, there's definitely some nuances, and when we're talking about the market and we're talking about the asset classes, we're not talking like you need to go get your doctorate in each one of these as far as your real estate knowledge. It's more like you're going to survey it and you're going to sit in a few classes, right? But you got to know enough to call BS or to challenge in areas where it's just not adding up, and ask intelligent questions, right? So to your point, if it's mobile home park, or if it's multifamily, or if it's A class multifamily versus C, there are nuances in there that are going to have a really big impact on the deal returns, the holding, a whole possibility that a whole bunch of different possibilities of how it's impacted you as a passive investor. You want to know, and you want to make sure that you can question and challenge accordingly.
Also, you have to understand the deal, and each deal has its own business plan, correct?
Yeah, for sure, man. So you want to understand how the deal is making money, and this isn't like, you don't need, again, like the doctorate underwriting in order to invest passively, but you do need to know at a high level the basic inflows and outs of cash, right? How much are they charging? What are the expenses? Does that make sense for the area? Again, back to that example of the rent. If they're saying they're bumping rents, $200 a door, you need to know whether or not that's feasible. And then if it is, to your point, what's the business plan? If this is a massive turnaround, if this is a big reposition, again, understanding what that is, because it will have an impact on your returns. You might, in some of these larger repositions, you might not get a return for a year, but then it's going to be very sizable returns years 2, 3, 4, and 5, because they need to reposition it, kick everybody out, and do the renovations. But you need to understand what that business plan is, because it's going to have a really big impact on your cash flows and your overall returns.
And that'll be written up before the plan is purchased, correct? Or before the property deal is made, you have the business plan in place to figure out how you're going to make money, correct?
Yeah, for sure. There's typically like a pitch deck that they will, these sponsors will put together on a deal specifically that'll show you kind of the high level, really high overview of the property, the location, why they think this location is, going to do better off than, some of the other submarkets. It'll typically give you an overview on the market as a whole. So I'll give you an example of our pitch deck that we have. It gives you an overview of the Tucson market as a whole, why we think it's good, why we think it's growing, some of the major employers in industry that are trending upwards, right? And then we'll dive into the submarket. So in where this property is located, we'll talk about the Starbucks that is half a block away, or the gym that just went in, or the median income, and like what's going on that makes this neighborhood appealing. And then we'll go into the deal itself. What are the returns? What's our business plan at a high level? This is a pitch deck that it's typically a little bit the 10,000 foot view. Are we planning on dramatically reducing expenses, or is there a bill back for utilities or rent increases or what have you? What is the play? What's the angle on this property? We'll also cover the team. So the bio, who are the sponsors, who are our external team? So property managers and accountants and CPAs. Like, it's good to know that sponsors have a bunch of rock stars in their corner, because again, we've talked about this before, you can't be the expert of everything. So if you have a sponsor who's saying it's a one-man band or one-woman band, that's not a good thing. You want to have expert CPAs and expert property managers and key players that will help you out. So that's the pitch deck. That's typically done, before you invest any funds into the deal, right? Then there's a bunch of paperwork beyond that. PPM, private placement memorandum, if I'm remembering that correctly, which is the legal jargon on the property. It tells you all the ways that you can lose money, essentially, right? And then the operating agreement as well, which will go over the limited partners. If there are any decision rights, typically they're not. It'll go over how the general partnership is structured and everything like that. So you'll see an operating agreement, which will have the 100 pages of legalese on how the deal is structured.
And you don't have to be, like you said earlier, you don't have to be, a Rhodes Scholar or a rocket scientist to understand or to make these pitch decks, but you should understand enough to read the pitch deck and find out how you're going to get paid. So, yeah,
your challenge, your goal in a pitch deck should be able to is try to poke holes in it, try to call BS in some of these. And if you can't, that's a good thing. And if you don't want to do real estate, you don't want to research this, it's really not hard. Google the rents, right? There are a bunch of resources that you can go Rentometer, call a property manager for crying out loud, and they'll tell you what the average rents are in the area, or give you a overview of the area. So do your high level research to make sure that you're not getting smoke and mirrors on the deal.
Yeah. Now on these syndications, there's a couple of different types of business plans and investments. And the first one there I like is the stable asset. And that's basically an asset that's been performing well. All the repairs have been taken care of. There's not really a lot of meat left on the bone other than your normal cash flow from the property. And that's why you're buying it, because it's, in essence, you would call it in residential, a turnkey property. It's all ready to live. It's all stabilized. You got all the apartments are filled. It's a low vacancy rate, and you just buy it for cash flow.
Yeah. Yep. And these aren't bad deals. Like, these are good deals, right? To your point, man, they're turnkey deals, which they're ready to roll. So you can usually get really good financing on them. Of course, there's always risk, but they're less risky than you buying a property that's 50% occupied, and you got to go in with limited cash flow and do a bunch of renovations. So they're good. To your point, they're just different, and typically you'll see lower overall returns because, again, that the perceived risk, right? And there's not typically a ton of upside or meat on the bone with these properties. They're typically fully renovated, fully rented out, fully occupied, and in decent areas. So yeah, it's not a ton of upside, but not a ton of risk either. So a good cash flowing, stable property.
And the next one, they're reposition underperforming assets. That's one of my personal favorites, is finding a mom and pop, if you will, that is underperforming, and figure out how to turn it around and make money, and then reposition it.
Yeah, for sure. And we could have about 30 episodes just on this subject alone. Yes, but it's repositioning an underperforming asset, just like you said. It's whether it's a mom and pop owner, whether or not it's a burned out landlord, or somebody who bought it. Well, I've seen a lot of these, especially in the area that I'm investing in, people who just don't give a crap anymore. Like, they've had these properties for 30 years, they're paid off, and at 50% occupied, it's still paying their bills because there's no debt on the property, right? So you'll find those a lot of times, and at this point in time, maybe they're just ready to get out of the game and they're ready to sell, but it's underperforming in some way. Either the expenses are way too high, or they're missing opportunities with charging back or with rent gaps, things like that. So if you can come in there and solve that problem, then obviously there's typically a bigger payout, because the idea is, in a sane and normal market, not always what we see right now, the idea is that you are getting the non-performing assets at a discount. Now, we are in insane times. Even in this COVID craziness that we're in right now, we still, a lot of times we'll see sellers wanting to get top dollar for these assets that are not performing. So 80% occupied, they want to get, the same price as if it were 100% occupied. And that's just crazy talk. So it doesn't always work that way. And in that case, if you're doing that, you paying full price for that asset, there's no upside for you. There's only downside. There's only risk. If you get it to 100% performing, well, you paid what it should be worth at 100% performing. Typically there's a opportunity there for you if you're getting it at a discount to what it should be at 100% performing.
And the next one here is the repositioning of asset usage. So that's actually completely changing the use of the property once you get it. And this is actually one that I'm thinking of right now, because my personal portfolio is, I'm able to add some in there that they're close enough to a college. I could actually reposition it as, instead of regular month-to-month leases and yearly leases for a regular rental property, I could turn it into student housing.
Yeah, for sure, man. This is one of those ones where it's like you get paid off for like how clever you are and the problem that you're solving. So to your point, if you reposition single family to student housing, if you are repositioned, a lot of people are doing hotel conversions in my market, where they're converting old hotels to multifamily properties, typically with a lot of studios and ones. But that conversion is there. I just saw recently actually an article about people that are the death of the strip mall. All these strip malls that are sitting vacant because people aren't shopping anymore, being converted to multifamily housing. So yeah, it's definitely a business plan that can work, and you want to find somebody. Typically, want to find somebody who's done it before, right? Because to your point, Larry, these are different business models. They're different ways of operating them. To your point, you're not going to operate a student housing the same as you would a straight up multifamily, because sometimes you'll do, it's very cyclical with like the tenants coming in for college, and then when they're leaving, and the lease structure is different. You rent by the bed, not the 2 or 3 bedroom versus a 6 bed, right? You can charge by the bed. It's a way different structure. So.
Yeah. And for the limited partners, they don't really have to come up with a business plan, but you have to understand these plans and how they're planning on making money in order for you to do your proper due diligence and make sure that you're choosing the correct deal for you.
Yeah. Use that logical mind and think to yourself, is this going to work? What could go wrong here? And ask those questions.
We've got types of returns and splits. These are what we're talking about. This is why you're in it. This is why you're investing. These are what get you paid. The first one there, you got the first two I see as being fairly similar because of the way it is, just different percentages. So you got 70-30 split and an 80-20 split. What are the splits?
Well, so the split is between what the general partner side get and what the limited partner side get. So to your point, 70-30 or 80-20 split, that's 70% going to limited partners, 30% going to the general partners, this can be split in any fashion. 80-20, 70-30 are probably the most common ones that I've seen, but it can be split in any fashion. So it's, as we dive into the metrics, as we dive into some key terms, like I said in the beginning, it's super important to understand how your sponsor team gets paid, because they're going to get paid and they deserve to get paid because they're doing a lot of the work on the deal. But you want to make sure how they're getting paid aligns with the interest of the limited partners. So what I mean by that is if you have a sponsor that's picking up a disposition or reposition or refinancing fee, that might incentivize them to get rid of the property sooner than you would like. So, right. And as a general partnership, they get to make all those decisions. So you just want to make sure that the incentives are aligned with the limited partners' goals as well. So, but yeah, man. So 70-30 split is a really good common one. Obviously, with 70% going to the limited partners versus 80%, typically there's less cash flow right off the bat. A lot of times there's what we call the preferred return in that as well, which just guarantees that, for example, like maybe the first 8% is typically, pretty common, would go straight to the investor. So you're the limited partner. So you're almost guaranteeing the first amount of cash flow that supplies that 8% return. And then there's usually a catch up and it would go 70-30 split after that. But
the IRR, What is IRR? It's that internal rate of return, right?
It is. And defining the IRR, it's probably one of the more complex terms to try to explain. But it's important because it's used to look at, again, kind of like the apples to apples comparison of properties, right? And as simply put as possible, it's the return considering the time value of money. So what's your return for the amount of time that however much your equity is invested in the deal? So obviously if your hold period is 2 years versus 5 years or 7 years, that's going to have a really big impact on your total return. So that's the IRR considers that time value of money when it's calculating the return. So
nice. So it takes into account the fact that your money has been unable to be used by you for 7 years or 10 years or whatever.
Mm-hmm. Yeah.
Okay. Next one there, average annual return. What is that?
One that's a little bit easier to understand. It's just exactly what it sounds like. It's your average return, your return added up each year divided by the numbers of years. So if you got 2%, year one, 3% year two, but then, the reposition kicked in and the business plan started pumping and you got 10% year three, 15% year four, you just take the average of those returns. So it helps you analyze deals that might be light on cash flow up front, then I have a really nice payout at the end, either with the sale or with the cash flows after the business plan is executed. Kind of helps you consider that when you're looking at the returns.
Equity multiple. What exactly is that?
Yeah, it's just a metric that's it's just total profit plus equity invested divided by your equity invested. So again, your cash flows every year. So, if I got $5,000 this year, $5,000 next year, $10,000 the year after that, I'm going to add all that up. I'm going to add in, my $100,000 initial investment, and then I'm going to divide it by 100,000. And again, it's that multiple of your returns on your equity. So
All right. So, well, Mike, you've sold me on being a limited partner, man. I'm ready to jump in. I've got a little bit of pile of cash here. I'm ready to get out there and find the deal for me. Now, how do I do that? How do I find a sponsor?
Yeah, I think that's a clear distinction. Find a deal or find a sponsor. Find a sponsor, right? That's where you want to focus on, because you're not tracking these deals down as a limited partner. That's not what you want to do. And as we covered on the previous episode, you need to have a pre-existing relationship. Typically, depending on what they're doing from a structure, there's a lot of times you need a pre-existing relationship with these sponsors. So finding that sponsor first is always the best bet. And if, when push comes to the shove, if I had to either invest money without looking at the deal or without looking at the sponsor, I would 100% want to look at the sponsor and ignore the deal altogether. Because when push comes to shove, if you got experienced sponsors who understand how to handle these deals, how to manage them, and have been through ups and downs of a real estate cycle, a lot of the times the deal will handle itself. But you can have a really, really stellar deal and have a crappy sponsor team and drives it into the ground. So the sponsor is super, super key to the deal success. So first and foremost, man, just like anything else, ask for referrals. Like, who has put money with with general partners before, and did they have a good experience? Ask around.
Yeah. Referrals. I mean, if they made money with the sponsor and they were above board, then that's excellently an excellent way to find a sponsor, because like we have said several times before, success leaves clues. And if they're making money for other people that you deal with on a regular basis and they give you that sponsor's name, then generally that'll help you at least narrow the field, if not pick the sponsor itself. So
yeah, for sure, man. I mean, you still want to do your form of vetting, because you never know. Maybe that person's only been with that sponsor for one deal and they got lucky, because we've been in a pretty crazy market, and a rising tide raises all ships, right? But you do want that'll at least help you go in the right direction. So get that referral, and not just maybe about the returns, but how was the relationship with that sponsor? Did they get all their questions answered? People are putting, sometimes multiple hundreds of thousands of dollars with these people. I want my questions answered, and I want to know that you are actually there's a good relationship there. So you want to make sure that part of it is answered as well. How do they feel about giving their money? How was the relationship? Was the communication there, and things like that? So,
and once you decide on a sponsor, say I've got my sponsor, I talked to Mike Moe and I said, hey buddy, how am I going to invest my money limited partnership style? What would be my next step? If I were you,
if what?
If I were you and I had found the sponsor, do I have to establish that pre-existing relationship first?
Well, typically you want to, but depending on the structure that they're doing, that's a requirement, depending on if it's a 506C or 506B, like we covered on the last episode. But yeah, you typically want, before you just obviously write a check, you want to have a good relationship. You want to have a few touch bases. You want to make sure that they understand your financial position and your knowledge about the industry and the asset classes that they're targeting.
And like you said earlier, are they transparent? Do they keep the investors informed? And then one of the things that I like to do is, when I find a sponsor, I'd like to try and get references. If I wasn't referred by a reference, I'd like to try and get an additional reference. Just say, could you give me some names of people who've invested with you that you've done returns from? And that's just good business, in my opinion, that you get the references from prior investors, so you can basically get the actual truth from these folks, because believe me, if somebody lost them money, they're going to tell you.
Yeah. So this is key, man. And this is where you can kind of cut through some of the BS, especially if you can get a decent list. And this is something that most most sponsors should be used to by now. I mean, this is not uncommon to be asked for. And typically, if you ask for 3 references, and then sometimes I'll go, okay, what's the next 3? Because sometimes people have these canned references, and their uncle or their best friend or whatever who's invested in the deal. So I typically like to go for the next list. So thanks for the 3. Can I get 3 more? But you definitely want to vet some references for sure.
Yep. And this next one, this is key for me personally, is I want to know when the distributions are going to start. When are my payments coming to me?
Yeah.
The sooner the better. And, sponsors generally can let you know when the distributions are going to start happening.
Yeah. And this should be something that's outlined in the business plan as well, because like I said, some deals won't have distributions for the first year, sometimes more. I mean, if you're investing in like a ground up project, you might not get distributions for 2 years, and you just got to understand that and be okay with that and make sure that fits with your strategy, because maybe once those distributions start, or the payoff once it's repositioned or sold is makes it worth the wait. But you just got to understand that, because there's nothing worse than investing in a deal and expecting okay, the deal's closed, maybe it closed a week ago, and you're thinking, well, in a month or two I might start getting my money, and it's like, well, distributions aren't starting until 2 quarters in, because they got to reposition or what have you. That should all be known ahead of time. No surprises.
The track record for the sponsor, that's a big one when you're vetting a sponsor. You want to know what their track record is in this type of project. Have they gone full cycle? That means from start to finish on a syndication.
Yeah, for sure, man. And to your point, full cycle on the property, buy, reposition, and sell. Obviously, you want to see a few of those, but it'd be great to know how long they've been doing it and whether or not they've just been investing in real estate the last handful of years. Well, that might not hold water as much compared to a sponsor who has been investing for the last 15 years. So obviously, what does that track record look like? They should have a really good kind of almost again like that pitch deck, but almost from a historical lens of what they've returned to their sponsors from a rate of return and from overall return to their sponsors. They should have that documented where you can see from a historical what their performance is.
And then, like you said, are they consistent in the market, the asset class? Who are their supporting staff? Do they have a good support staff in place? And that basically is who, Mike?
Well, yeah, it could be their property managers, asset managers, accountants. Like we said, one-man bands, one-woman bands are not good things necessarily, because real estate's tricky. Taxes are tricky. The accounting is tricky. You want to know that they have those experts in their corner and they're not trying to do this all themselves. And they're not trying to save, money by, you don't want them going out on Fiverr and finding an accountant. You want to have like a true, person who is in the industry, a professional doing these tasks for you. And the other thing I want to touch on, man, that you touched on there at the beginning is to make sure that they're consistent in the market, asset class, and project type. So what I mean by that is you might have somebody who's been investing 10 years in multifamily, but now they're going to go try their cards in mobile home parks, and this is their first syndication. Well, it's very different business. It's a very different operation. So you don't want to be that experiment. You want to make sure that they got a couple under their belt in that asset class or in that market before you toss some money with them. But
yeah, and it's just important. I mean, the more experience they have, the better it's going to be for all the partners involved. How about evaluating an offer? What exactly is evaluating the offer?
Well, man, that's looking at the asset as a whole. The property is looking at how the general partners are structuring the deal. Again, going back to that split, going back to how people are getting paid. So, general partners and sponsors can make this as complicated or as straightforward as they want. And really, I'm simple. I like it pretty straightforward. The more complicated people structure these deals and to where you can't even tell how or when people are getting paid, the less I'm likely to invest in this. So what I mean by that is sometimes you'll get sponsors who have all sorts of hurdles and incentives where it'll start out maybe as a 70-30 split. But if they surpass this benchmark, it'll go up to 75-25, or if they surpass this return, it'll go to a 50-50 even, or on sale, it's a 50-50 between the equity. And that's a big deal because you're on sale, you're realizing a lot of the value that has been driven from that plan. So if you're giving up 50% of that sale price or the sales profit, that's huge. So again, simplicity is key on these. I like to see sponsors who structure their deal pretty dang straightforward and don't have a bunch of 30 pages on how people get paid.
Yeah, and I just came up with it's called the KISS method. I didn't come up with the KISS method, but I changed it because at the end of it I didn't really care for. It's keep it simple, sponsors.
Yeah, there you go. I love that. That's pretty clever, man. And absolutely, keep it simple, stupid. I mean, sponsor. Because that is, it's true, man. This confused mind doesn't make a decision. Right? I forget things. I'd probably just butcher that quote, but if you can't understand how people get paid, you should probably walk away.
Absolutely. And then the last thing there is the fees that are involved with the syndication. The limited partner really needs to pay attention to what the fees are involved, because that has a direct impact on the amount of money they're going to make.
Yeah, and again, it should be part of that plan and should be part of that structure. But there are some common fees that are acceptable, right? So, like acquisition fees, we talked about that. Anywhere from 1% to 3% of the sale price of the property is reasonable, or is pretty common. The disposition fee, I'm not a big fan of the disposition fee. Again, I don't think you should. There's not as much work in selling a property as there is in acquiring one, right? So just to get another 1% to 2% on the sale of the property is it's not as common, and I would push back on that one fairly hard. And then the asset management fees. So obviously these deals aren't running themselves. There's property managers, but there's still a ton of other work from the asset management that needs to be done. So there'll a lot of times be asset management fees. And you'll typically see, really good and successful sponsors and known sponsors have the ability to charge a little bit more on these fees versus some of the newbie syndicators will not charge these fees. But again, that's not always a good thing. If you see no fees on there, maybe just question the track record a little bit. But those are some pretty common fees. Yeah.
And I definitely want to say one thing. You want to vet the sponsors, but don't necessarily discount a sponsor just because of experience, considering the fact that I'm planning on eventually doing syndications and I have done none yet. So
yeah.
And everybody needs to learn somewhere, but that's where you can bring in more experienced people to help take care of the experience aspect of it and get you some experience under your belt.
Oh yeah, for sure. You want to assess the sponsorship team, and typically there's, anywhere from 3 to, I think I've seen 7 or 8 in some of them, and there's always usually a handful of people who are really seasoned, right? And there'll be maybe a few where this is their first deal. So you want to look at that as a collective team with their track record and their experience. But yeah, I wouldn't discount team of sponsors because there's 1 or 2 newbies on there, especially if they got some tenured folks on there as well.
Well, that's everything I've got on limited partnerships. We've covered quite a bit of material on that, man.
Yeah, that was a good one, man. And we have an interview coming up with somebody who has kind of cut their teeth on the limited side. It has primarily done limited partnership and it has gotten to financial freedom through limited passive investing through syndications. So
yeah, I'm very excited about next Thursday's episode as well. That's going to be a great interview.
More to come on this exact same subject, folks.
Absolutely. Call to action, my friend. Looking into opportunities?
Yeah. So again, I think, last time we talked about looking at finding a sponsor if you're thinking about doing a limited partner, but not vetting it, because we would talk about that at this time, right? So now that you found that sponsor, found that potential general partner that you might want to put some money with as a passive, take the information that we talked about and vet them from a track record, from, how have they done with this deal type, asset class in this market before, and all the things we talked about, vetting a sponsor with their track record and all that. Do it. Put them through the paces, find the questions, find the business plan, find the pitch deck, put your list of questions together, schedule a call, and start asking questions and vetting that sponsor.
Mm-hmm. And like you said, it's one of those things where you want to start developing those relationships early. Another thing that I'd like to also point out is you really have to figure out exactly how much money you're going to have to invest when you do become it. Because, if you have to go through an accredited investor program, then you have to know what an accredited investor is, and you have to make sure that you fit those stipulations so you're not getting anyone in trouble.
Yeah. And to your point, there's to know how much you have to invest. A lot of times there's minimums. Well, there's always minimums in these syndications, and usually they're at 100,000. There's some GPs that'll take, 50,000 or lower investments, but usually the minimum's 100 grand. Obviously know that going in, but your sponsor should detail what his minimum or her minimum is as well.
Well, that was an excellent episode, man. I'm looking forward to next Thursday's episode, and I'm also looking forward to the Monday morning vote. I just look forward to all of it, man. I'm just excited. I'm very excited.
That's good, man. I'm looking forward to the interview next week as well. So it'll be a good one, and we got a couple good ones lined up this month. So looking forward to that. So
some excellent content coming up. So stay tuned.
Yep. So, all right, man, that's all I got. So thank you guys for tuning into another episode of the Real Estate Marathon Podcast, and we'll see you next time.
You guys have a great one.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group, or follow us on Instagram and Twitter at Real Estate Marathon Podcast.